Every single year, ordinary people who work a normal job, the kind of job where taxes come straight out of your paycheck before you ever see the money, quietly overpay the government by thousands of dollars. Not because they did anything wrong, but because nobody ever told them about a handful of perfectly legal moves sitting right there in plain sight. By the end of this video, you'll know 7 of them. 7 ways a regular W-2 employee leaves money on the table every April, and exactly how to stop. Here's the myth that costs people the most. If you're a W-2 employee, meaning you get a paycheck with taxes already withheld, not a business owner sending out invoices, you've probably been told there's nothing you can really do about your taxes. The business owner gets all the clever write-offs. You just pay whatever the system says. And that is mostly wrong. You don't get as many levers as a business owner, that part is true. But the levers you do have are powerful. They're completely legal, and most people never pull a single one of them. In fact, the government wrote them into the law on purpose, to nudge ordinary people to save and plan ahead. The only catch is that they don't send you a reminder. So let's walk through the 7 that matter most, with real numbers, starting with the one that's the closest thing to free money you will ever find. Move 1. Capture your full employer match. If your job offers a 401k or a 403b, if you work for a school or a nonprofit, there's a good chance your employer offers to match part of whatever you contribute. A very common setup is a full match on the first 3% of your salary, then a half match on the next 2%. Put that into real dollars. Say you earn $50,000 a year. Contributing 5% of your pay could trigger an employer match worth around $2,000 a year, dropped straight into your retirement account, for free, simply because you saved your own money first. If you're not contributing enough to collect that full match, you are quietly turning down a raise. There is no investment anywhere that reliably hands you an instant 50 or 100% return the way an employer match does. Fix this one before anything fancier. Move 2. Choose traditional or Roth on purpose, instead of leaving it on the default setting. Inside that workplace plan, and inside IRAs too, you usually get 2 flavors. Traditional means the money goes in before tax. It lowers your taxable income this year, and you pay the tax later when you pull it out in retirement. Roth is the mirror image. You pay the tax now, and then it grows and comes out completely tax-free down the road. Neither one is universally better. It honestly depends on whether you expect your tax rate to be higher today or higher in the future. But here's the move almost everyone misses. They never actually decide. They take whatever box was pre-checked the day they signed up and never look at it again. Spend 10 quiet minutes choosing the one that fits your situation. Many people earlier in their careers, in lower brackets, lean Roth, and you've just turned an accidental tax decision into a deliberate one. Move 3. If you're eligible, use a health savings account, an HSA. I'll keep this one short because it earned its own full video. The short version. If you're on a high-deductible health plan, the HSA is the only account in America that's tax-free 3 separate times. The money goes in tax-deductible, it grows tax-free, and it comes out tax-free when you spend it on healthcare. Most people treat it like a little checking account for copays. Treat it instead as a long-term invested account. It quietly becomes one of the most tax-efficient dollars you will ever own. If you have access to one and you've been ignoring it, that is a powerful move, sitting right there waiting. Move 4. Open your own IRA. You do not need your employer's permission for this one. It's the account people forget even exists. An individual retirement account is something you open yourself, at almost any brokerage, completely separate from your job. In a recent year, you could put in up to $7,000, or $8,000 if you're 50 or older. Choose a traditional IRA and qualify, and that contribution may be deductible, meaning it can shave a real chunk off your taxable income for the year. If you go Roth instead, there's no deduction today, but every dollar of growth later comes out tax-free. Either way, this is an entire tax-advantaged account that has nothing to do with whether your employer offers a good plan or any plan at all. Plenty of W-2 earners have a 401k at work and can still open an IRA right on top of it. Move 5. Raid the pre-tax menu your employer already offers. Beyond the retirement plan, A lot of workplaces quietly offer a whole shelf of pre-tax benefits that people scroll right past during open enrollment. There's the Flexible Spending Account, or FSA, which lets you set aside pre-tax money for medical costs. There's a Dependent Care FSA, which can let you put aside several thousand pre-tax dollars for daycare or after-school care. And if you're already paying for childcare, that one is enormous. Some employers add pre-tax commuter benefits for transit or parking. Every dollar you route through one of these is a dollar that simply never gets taxed. The one catch with an FSA is that it's often use it or lose it within the year, so you estimate carefully. But for predictable known costs like childcare, skipping it is leaving free money behind. Move 6. If you invest in a regular taxable brokerage account, get to know tax loss harvesting. It sounds advanced, but the idea is simple. In an ordinary investment account, not a retirement account, if one of your investments has dropped below what you paid for it, you're allowed to sell it and lock in that loss on paper. That realized loss can offset gains you made elsewhere. And if your losses outweigh your gains, you can use up to $3,000 of the difference to reduce your ordinary taxable income for the year, then carry whatever's left into future years. So a decline you were already living through gets turned into a real, usable tax deduction. There are rules. Most importantly, you can't buy the same investment right back within a short window, or the deduction is disallowed. So this is one worth reading up on, or running past a professional. But it's a perfectly legitimate tool that ordinary investors overlook all the time. Move 7. Claim the credits you've actually earned, and then tune your withholding. First, the credits. A deduction lowers the income you get taxed on. A credit is far more powerful because it cuts your tax bill dollar for dollar. One that W-2 earners miss constantly is the saver's credit. If your income is modest and you contribute to a retirement account, the government may hand you a credit worth a few $100s or more, literally paying you to save. Huge numbers of people who qualify never claim it, purely because they don't know it's there. And second, the quiet one, your W-4, the little form that decides how much tax is withheld from each paycheck. If you get a giant refund every spring, that is not a gift. It means you handed the government an interest-free loan all year, and they're simply returning your own money. Tune your W-4 so your withholding lines up with your real bill, and that cash lands in your hands every single month, where it can actually work for you. So here's all 7 in one breath. Collect your full employer match. That's free money. Decide traditional versus Roth on purpose. Use an HSA if you're eligible. Open your own IRA with or without a workplace plan. Mind the pre-tax menu at work, FSA, dependent care, commuter benefits. Harvest your losses in a taxable account. And claim your credits, like the saver's credit, while tuning your withholding so you stop overpaying all year long. Not one of these needs a business, an accountant on retainer, or a single shady trick. They are all sitting in the tax code on purpose, waiting for you to use them. If you only do one thing this week, start with the first one, because it's the biggest and the simplest. And it's exactly what the next video breaks down in full. The 401k match, the free money most people leave behind, and precisely how to make sure you collect every dollar of it. Subscribe so you don't miss it. And one last thing before you go, this is general education, not financial or tax advice. The rules, the income limits, and the dollar figures genuinely change from year to year and depend on your own situation. So always check the current numbers and consider talking to a qualified tax professional before you act.